I will be summarizing 2 chapters from the tax books that I have read that have helped me a lot in understanding what needs to be done for taxes. They are Tax Strategies for the Savvy Real Estate Investor, Volume 1 and 2. I still highly recommend that everyone pick up both books. They are not just for real estate investors and are filled with lots of great information. I will include a link for both books in the description. Chapter 3: Retirement Planning. This chapter is all about preparing for retirement. Most people think of retirement strategies as using a 401k. A typical 401k usually is a mutual fund that purchases collections of stocks that compounds over a person's life. While the stock market has had around a 7 to 10% growth over the last century, there are other options for people. This option is a self-directed IRA. This is a retirement account that you have complete control over, and as you can imagine, you can invest this money into real estate, even going as far as to borrow money from a bank to help purchase a property. Not only that, but you can move your money from an existing 401k to a self-directed IRA. There are a few drawbacks to using this though, one of which includes a tax called Unrelated Debt Financed Income, or UDFI tax. This tax is partially based off of any money that was borrowed from a bank and not the actual retirement savings. There is, however, an option called a self-directed solo K. This account negates the UDFI tax by reinvesting the money back into the account. You can also borrow money from it. As always, speak to a CPA about these and do your own research. These strategies mean that you aren't passively investing, you are now actively investing. Chapter 4: IRS Pitfalls. This chapter is about potential mistakes people can make when trying to calculate tax savings. One pitfall is not separating depreciation between land and the property. Depreciation is when your property decays over time and requires repairs. Land does not do this, so getting the right values is very important. There is also accepted depreciation using cost segregation study. This is where a rental property is broken into smaller assets that depreciate at different speeds. Since some assets break quicker, more taxes can be avoided. If a property is to be given to a family member after they die, it should be transferred as an inheritance, not as a gift. This is because it will give a basis step up to the property, meaning that if a property appreciated $100,000 and was inherited, that $100,000 wouldn't be counted as capital gains, and the appreciated value will now be the new default value.